In 1972, Buffett paid $25 million for a candy shop, 3 times its book value. Wall Street gasped. They thought he had overpaid for melting chocolate, but Buffett wasn't buying chocolate at all. He was buying one invisible thing nobody could copy, an economic moat. And by the end here, you'll spot a real moat in any business yourself. This is the idea behind every Buffett fortune. A great product is not a great investment. Products get copied within months by hungry rivals. What protects profit is the wall around the product. Buffett borrowed the word moat from old castles. A castle keeps its treasure if the moat is wide. A business keeps its profit the very same way. Without a moat, competitors swim straight in. They cut your prices until the profit vanishes. So the first question Buffett asks is simple. What stops a rival from stealing this profit? If the answer is nothing, Buffett walks away. If it is solid, he leans toward the ledger. There are exactly 5 kinds of real moat. Learn these 5 and you can judge any company. Moat 1, the brand people will pay extra for. Back in 1972, that candy shop was See's. Anyone can melt sugar and cocoa into a box. Almost nobody sells it as the See's red box. Californians gift it every single December holiday. They would feel cheap handing over a rival brand. That feeling is the moat Buffett saw in the mind. So Buffett raised See's prices a little every year for decades, and customers barely flinched. That 25 million shop returned over $2 billion in cash. Buffett calls See's the business that taught him moats. Before See's, he hunted only cheap, ugly businesses. Graham had trained him to buy cigar butt stocks. One free puff, then the value was gone. See's showed him a brand puffs forever. So pricing power is the test of a brand moat. Ask, can it raise prices without losing buyers? If yes, the brand is a genuine fortress. If a coupon decides the sale, there is no moat. Coca-Cola is the giant version of this same moat. In 1988, Buffett bet over $1 billion on Coke. A century of trust priced into one red curve. Order a cola anywhere and you picture that bottle. Buffett said a rival with $100 billion couldn't unseat it. That, he said, is the widest moat in the world. Moat 2, switching costs that chain the customer. Some products are painful and scary to leave. Picture the red software running an entire bank. Ripping it out could freeze every account overnight. So the bank pays for 10 years without shopping. The cost is the pain of change, not the price. Buffett's Apple wrapped this moat around your life. Your photos, messages, and apps live inside it. Leaving Apple means rebuilding your whole digital world. So 2 billion people stay and upgrade and stay. Buffett bought Apple and called it a consumer brand, not tech. A sticky habit people refused to drop. By 2018, it was Berkshire's single largest holding. To spot switching costs, Buffett asks one blunt question. How much would it hurt the customer to leave? More pain to switch means a deeper moat. Banks, payroll software, surgical tools all share it. Once embedded, Buffett knows they stay 20 years. Moat 3, network effects that feed themselves. Some products get better as more people join. One lone telephone is a useless dark paperweight. 1 million telephones become a priceless network. Buffett saw this in American Express decades ago. Millions of card holders, so shops must accept it. Millions of shops, so more people carry the card. Each side pulls the other in, a spinning flywheel. When the salad oil scandal crashed the stock in 1963, Buffett bet big because the network stayed intact. Card holders kept paying. Shops kept accepting. The panic was loud, but the moat never cracked. To test a network moat, ask if it self-reinforces. Does each new user make the product more valuable? If yes, Buffett knows it is hard to dethrone. A challenger must rebuild the whole web at once. Almost nobody can, so the one leader keeps profit. Moat 4, a cost advantage rivals cannot match. Make it cheaper, and you win, Buffett says. Buffett bought a railroad for this exact reason. In 2009, he paid $34 billion for BNSF, Buffett's biggest purchase ever made during a recession. Why a boring railroad in dark times of all things? Because moving freight by rail beats 50 trucks on cost. One BNSF train hauls what hundreds of trucks cannot, and nobody will lay parallel tracks beside Buffett's. The land, the rails, the routes are already taken. That permanence is the cost moat poured in steel. Costco runs this play, says Munger, on razor margins. It buys so much it pays the lowest 1% price. Rivals selling smaller volumes simply cannot compete. Buffett says scale becomes a wall built from size. To test a cost moat, find the structural reason. Is it scale, location, or a rare gold resource? A reason rooted in structure tends to last 30 years. Munger warned, a luck moat disappears overnight. Moat 5, intangibles, patents, and one scarce license. Sometimes the law itself builds your fortress wall. A drug patent gives one maker a legal monopoly. For 20 protected years, no rival may copy it. Buffett's Moody's prints the ratings Wall Street trusts. Regulators practically require its stamp on bonds. That blessing is a license to print money. A liquor license or airport slot works the same way. Scarce permission keeps competitors locked outside. So those are the 5 moats Buffett hunts. Brand, switching costs, network, cost, and the law. Now the hard part. Spotting a fake moat. Fake moats fool Wall Street every single cycle. Fake moat 1. A great product with no protection. A hot gadget today is a cheap clone next year. Without a wall, Buffett watches the profit leak. Fake moat 2. Being merely first to arrive. First movers get overrun unless a wall follows. Buffett saw many early leaders end up broke. Fake moat 3. Fast growth mistaken for a moat. Growth feels like strength but invites attackers. If the profit is fat, rivals pile in hard. Buffett asks, will this still dominate in 10 years? If he cannot picture it, there is no moat. Fake moat 4, a brand nobody will pay extra for. If it only sells on sale, the moat is hollow. So always return to the pricing power test. Real moats let you raise prices and keep buyers. Fake moats collapse the moment a cheaper rival appears. Here is the test Buffett actually uses simplified. First, find where the profit comes from. Second, ask what specifically protects that profit. Third, name which of the 5 moats it is. If you cannot name one, assume there is none. Fourth, ask if that moat is widening or shrinking. A shrinking moat is a slow, quiet trap. Buffett wants moats that get wider every year. C's, Coke and BNSF all widened over decades. That widening is what compounds your money for 30 years. Now picture spotting this in a business near you. Watch where people gladly pay 20% more. Watch what nobody dares to cancel or switch. Watch the one service everyone uses because everyone uses it. Watch the seller who always undercuts and survives. Buffett watched the license rivals cannot obtain. Spot one of those and you have found a moat. That is the whole skill and you now own it. Notice what this method never once asked about. No stock chart, no hot tip, no next quarter. You judge the wall, not the wiggling price. Mr. Market screams about prices every single day. A moat compounds quietly for decades regardless. Buffett paid triple book value for that candy shop because the wall around it was worth far more. That 25 million bet returned over 2 billion in cash, not from the chocolate, from the invisible moat. Now you can see that ring in any business too.